Welcome to China Events, I am Jason. Earlier this month, the international rating agency Fitch abruptly downgraded the credit rating of the United States, triggering a strong condemnation by the United States Treasury Secretary Yellen. According to the United States Treasury Department, the weighted average interest rate on its total outstanding debt is currently 2.76%, which is the highest level since 2012. If the Fed does maintain higher rates for longer, the combined debt rate will exceed 4% within a year. Interest payments on the U.S.'s whopping $32.7 trillion total debt would reach at least $1.4 trillion within 12 months, potentially making interest on the debt the largest single U.S. federal expense. And the surge in interest on the U.S. debt will be a major topic of conversation in 2024. Combine this with the fact that the rating agencies have already warned of the risk of a renegade U.S. default by way of downgrades, U.S. yields are rising and U.S. bonds are falling. Just explains one of the deep reasons why U.S. Treasury Secretary Yellen has repeatedly warned that the U.S. will be plunged into an economic and financial catastrophe if it cannot continue to borrow new money to pay off old debts, before she strongly objected to the U.S. being downgraded. Next, Ackman, a well-known U.S. hedge fund magnate, made a high-profile tweet claiming that he would be shorting 30-year U.S. bonds to hedge against the impact of rising long-term interest rates on the stock market. Ackman said the short is a high-probability, independent bet. As for Ackman's short U.S. debt reasons, in fact, and Fitch downgrade of the U.S. credit rating reasons are not very different. All because the U.S. government is now unable to make ends meet. Defense and military expenditure, residents' welfare expenditure is getting bigger and bigger, but the financial revenue is stretched to the limit. The future want to continue to live on, can only continue to issue debt. The U.S. Treasury continues to issue debt, will inevitably extract liquidity from the Treasury market, which in turn brings the decline in the price of Treasury bonds. Yields continue to go up. In the final analysis, Fitch and Ackman believe that the United States is now a bigger and bigger hole. The future can only rely on the issuance of debt to get by, and the U.S. debt snowball is getting bigger and bigger under the mine is just a matter of time. Countries around the world have sold U.S. debt, the United States has been burnt out. Now Wall Street Big Brother also followed the mix in, for the United States, undoubtedly not good news. But for China, the action of selling U.S. debt will not stop. Long-term reduction of U.S. debt is still our long-term trend, will not change. August 2, the U.S. Treasury Department for the first time in nearly 3 years to raise the volume of longer-term bond issuance from $96 billion to $103 billion, exceeding market expectations of $102 billion. In fact, as the Federal Reserve continues to raise interest rates, the U.S. government spending continues to increase. The fiscal deficit problem has become more prominent. As of mid-July, this year's U.S. fiscal year deficit has reached $1.393 trillion, while the same period last year's fiscal year deficit of $515 billion, more than doubled. Seeing that the hole is getting bigger and bigger, the U.S. government is bound to issue more Treasury bonds, causing the supply of bonds in the market to exceed demand, leading to a continuous decline in prices and a passive rise in yields. This is why Fitch will choose to downgrade the U.S. sovereign credit rating. Wall Street high-profile claims short 30 years of U.S. debt, essentially because the U.S. government's money is always not enough to spend. You have to borrow money in order to live. Since the United States suspended the debt ceiling at the beginning of June this year, until 2025, the United States debt issuance will no longer be subject to debt ceiling restrictions. This has led to the United States into the last madness. The debt ceiling bill came into effect, began issuing huge amounts of U.S. debt, rebuild the TGA account balance. A number of institutions in the market is expected. The U.S. Treasury may issue more than $1 trillion scale of Treasury bonds during the year. The U.S. government's lack of money degree can be seen. With the increase in the size of the U.S. long-term bond issuance, the U.S. Treasury bonds are also falling, and now the U.S. 10-year bond yield has risen to 4.09%, reaching its highest level since November last year, and the 30-year bond yield is also rising, has risen to 4.3%. Ackman, a Wall Street bigwig who is ready to short the 30-year U.S. bond, believes that if the U.S. inflation rate stays around 3% in the future, the 30-year U.S. bond yield is likely to go further up to 5.5%. However, although the U.S. government is very short of money, has reached the point of needing to rely on debt issuance to make ends meet, but the mouth is still as hard as ever, has been claiming that the economic resilience of the family is very full, the labor market is cooling, the U.S. economy will not fall into recession. But the U.S. government, mouth on a set behind a set, is the traditional skills. Now the global countries are selling U.S. debt, the U.S. domestic cannot afford to take on such a huge amount of debt. What else can be done? In order to be able to harvest, had to brag about a variety of first of all, the funds cheated into the first to find people for the United States debt to take over and then say. In the final analysis, you figure is the high interest rate of U.S. debt, the U.S. figure is your principal. If you really take over the U.S. debt, I am afraid that in the end it will end up with a lost results. July 18, the U.S. Treasury Department announced in May the U.S. debt holdings data. In May this year, China continued to reduce its holdings of $22.2 billion U.S. debt. U.S. debt holdings fell to $846.7 billion, which is also China's holdings of U.S. debt in the 7th consecutive month, once again for the 2nd consecutive month to reduce positions. At the same time, as the largest U.S. overseas debtors, Japan also reduced its holdings of U.S. debt by $30.4 billion in May. U.S. debt holdings fell to $1.0968 trillion, with signs of falling below $1 trillion. Obviously, China's sale of U.S. debt is still a long-term trend. The main theme of the reduction has not changed, and not only that, many countries around the world are on the road to reduce U.S. debt. To put it bluntly, when the U.S. use of the dollar hegemony continue to harvest the world, the dollar again and again weaponized, other countries have made up their minds to go to the dollar, and are doing everything possible to avoid the risks brought about by the hegemony of the dollar. China, for example, has been actively promoting the internationalization of the renminbi this year, which has led to a number of countries, including Brazil, Saudi Arabia and even France, using the renminbi as a means of payment to conduct trade. And in addition, China's central bank is also increasing its holdings of gold. Relevant data show that in the first quarter of this year, China increased its holdings of 58 tons of gold. Total gold reserves have risen to 2068 tons. With the dollar hegemony further shaken, the uncertainty of U.S. debt gradually increased. China is constantly selling U.S. debt, increased gold holdings, showing the attitude has been very clear. Whether it's Wall Street bigwigs shorting U.S. bonds, or Fitch downgrading the U.S. credit rating, China and a host of other countries selling U.S. bonds, the underlying reason is the same. Sooner or later, U.S. bonds will thunder has become a consensus, the difference is only early or late. How to achieve the dollar, to avoid the risk of U.S. debt, is now the top priority.